Hello, this is Professor Gimetti. For every lesson that we have in Accounting 101, I will produce a video. Because the first and second lesson are fairly brief, I'll combine them for this video. So this video is going to be for both lesson 1 and for lesson 2 in your outline, in your course outline. In lesson number 1, we talk about the 3 basic activities of accounting, which are, I call it IRC, identification of transactions, recording those transactions by summarizing them into categories, and then once they're summarized into categories, we communicate that to users for decision-making purposes. Okay? We have internal users and external users of financial information. This course will deal with external users. This is financial accounting that deals with external users. And in our next course, Accounting 103, managerial accounting, excuse my handwriting, we will talk about internal users. Now, what is the difference? Internal users, managers who run the business need information to find out what areas are efficient, which are inefficient, and make changes accordingly. Whereas external users are people like investors, potential investors, current investors, creditors, that means bankers, people who the corporation, who the businesses owe money to. They need information on whether they're able to make the payments that they've been making on their loans. And taxing authorities, the government, they want to know how much they made in profits so that they can tax those profits. Regulators, SEC, Securities and Exchange Commission, they are the external users, and they require financial statements. And we're going to talk about which financial statements they like to see, which are standardized, and that is the basis for financial accounting, this external reporting, okay, communicating these financial statements to decision makers. Okay. Now, in lesson 2, we talk about ethics. How does ethics relate to accounting? What are ethics? Well, ethics are your standards of conduct, that which determines what is right and what is wrong in terms of behavior. What is honest and dishonest, or fair or not fair. That's basically what ethics are. And unfortunately, back in the early 2000s, there were some unethical business people who really messed things up for the rest of us. They were not acting ethically, and they falsified these financial statements that external users used. Those people then use those financial statements to make decisions, to put their money toward, or make financial decisions with, and they were completely false. So when it all fell through, a lot of people were really hurt financially, and the government said, we don't really want that to happen anymore. So with Sarbanes-Oxley, they put in measures to safeguard that from happening, and basically said the board of directors of corporations, which we'll study later, must be more responsible for these disclosures, these financial statements that are being put out. Okay. They recognize that the ethical dilemmas existed, that people like corporate executive officers wanted to boost up the financial statements to increase their own personal wealth, potentially at the expense of other people. And they came down pretty hard on them in this Sarbanes-Oxley Act. So now there are measures in place that protect people from fraudulently dealing with financial statements. I have written down here GAAP. That stands for Generally Accepted Accounting Principles. Those are basically the laws of accounting, generally accepted accounting principles. And there's also, GAAP is basically the United States. Prior to, I'd say 2005, GAAP was universally accepted throughout the world. some of the countries of the world became more industrialized and wanted to create their own accounting standards, so they set up the IASB, which is the International Accounting Standards Board, from which they promulgate the IFRS. The IFRS stands for the International Financial Reporting Standards. Okay? Those are the laws for international accounting that are issued by the IASB. Generally accepted accounting principles, that's American, are made up from the Financial Accounting Standards Board. We call it FASB for short. So again, FASB, Financial Accounting Standards Board, makes up the laws of accounting in America, which are called Generally Accepted Accounting Principles. The IFRS is the body which comes up with the International Financial Reporting Standards are the laws for international, which are made up by the IASB, the International Accounting Standards Board. Okay, now, where they differ somewhat is in this cost principle. The cost principle simply means that on the books of corporations, of businesses alike, always record things at their cost. Let's not try to guess what the fair market value will be. Let's just go with the cost. Now, there's a little bit of a problem with that, in that, for instance, the General Electric Company has buildings that are 100 years old that are still being used. Initially, they probably cost maybe $1 million to build, but today they're worth probably $20 million. They're enormous buildings that research isn't conducted in, and it would be extremely difficult to replace them for $20 million. But GE built them 100 years ago for what was then $1 million. So this cost principle is kind of difficult to deal with at times, but it is the one cost that we know for sure is accurate. We can count up all the invoices that it took to build a building, and that is no doubt objectively the cost of that building. When we talk about fair market value, if you asked 30 people to go out and come up with what they thought is the exact dollar value of Warner Hall, I'm sure you would get 30 different answers. So it means it's all over the place, and for accounting purposes, we generally don't like to do that. Okay? That is the cost principle. Now, with the monetary unit principle, that means, or the assumption of the monetary unit, it means that we're trying to base everything on transactional data that's expressed in dollar terms. So, for instance, if I go out and buy a company, okay, I'm a corporation, and I buy out a competitor, I know exactly what that dollar value is. Do I know, if I don't buy it out, what the dollar value is as to how it's going to affect my sales? Okay, if I buy out a competitor, I no longer have to worry about how their business is affecting my sales. But if I don't buy them out, how do I know? Well, that's really not a transaction. A transaction is when I do actually buy them. I paid $1 million for that company. I've bought them out. But if I don't buy them out, I really don't know the exact dollar impact on my sales. So I don't record that. I can't express it in a monetary unit. So only those things that can be expressed in a monetary unit are those things that get recorded. Okay. Now, we have another concept called the separate entity. The separate entity means that I, for instance, own an accounting and tax practice. I have personal transactions. I have to go to the grocery market and buy groceries. I go on vacation and I spend money for that. I buy computers for both my home and for my office. All of that needs to be separate. I keep my business affairs and my personal affairs completely separate. I have my own business checking account and I have my own personal checking account, and I always keep those separate. And when we're talking about entities, there are basically three types of entities: sole proprietors, partnerships, and corporations. The big difference being, with a corporation, you have limited liability. What that means basically is, and many of you probably studied this before in your business law classes. What it means is that if a corporation is organized, the investors, the shareholders, put in a certain amount of their own personal money, and the most that they could possibly lose is that investment and nothing else. Whereas for a proprietor or a partner, they could lose everything. If a sole proprietor has a lawsuit, and that lawsuit is for $1 million, they could take not only the assets of the business, but also the owner's personal assets. And we'll talk a little bit more about these entities, because we also nowadays have LLCs and LLPs, and we're going to want to know a little bit more about that. There's a little bit in your books about it, but I'll discuss that a little bit more when we get to class. In any event, Accounting 101, this is lesson number 1 and lesson 2. I am Professor Gimetti, and thank you for listening. Appreciate it.